the genesis of my sort of thinking in terms of feeling like I wanted to be more public about some of this stuff was almost a year ago now, where I was looking at economic data in the US and a bit baffled why, despite relatively weak numbers in a host of sectors, the US economy was still, in terms of GDP growth, was still doing relatively well. So I started unbundling the numbers and doing a bunch of analysis and stuff. And that's where I got to this idea that, and this has been true now for almost 7 quarters in a row, I guess, that AI capex writ large has been the largest fraction, as much as 50% and 60% in some quarters of US GDP growth. So not of GDP, obviously, because GDP is a very large number, it's trillions of dollars, but in terms of GDP growth. And so that was really startling to me. And I thought, okay, everybody must know this. I can't be the first idiot to have figured that out, because this is just basic math. And I started talking about it, and I was talking to the Wall Street Journal and the Financial Times and a bunch of other people. And I was like, wait a minute, nobody seems to really realize this is the case. And this is hugely important just at a macro level as you're thinking about markets, because it's kind of like the analogy I make all the time is that it's like my dogs, right? And like when the mailman walks by, comes to the house, they bark and bark and bark. And then the mailman leaves and they're like, I've got this. I know how to make mailmen go away. Because if I just bark, the mailman leaves. And then what the problem is that's just a broken model of like dog causality, right? The dog thinks he made the mailman go away. But the reality, of course, is the dog would have gone away, or the mailman would have gone away whether the dog barked or not. So this is the exact same thing. And in the context of why, from a macro market standpoint, understanding the constituents of GDP growth really matter. Because if you don't understand that the thing that's driving GDP growth is AI capex, you're liable to assume it's any stupid thing, right? So you might think it's tariffs. You might think it's just, animal spirits. You might think it's anything. And so unless you understand the causal structure of what's driving GDP growth, you end up making bad policy decisions, you make bad investment decisions, make bad decisions across the board. So that's where this all started for me, was at this level of people fundamentally misunderstand the nature of how the world has changed. And in particular, this one thing, this AI capex, the capital expenditures related to AI, hyperscalers, and what have you. And then that got me down the rabbit hole of, what is that? What's actually happening? What are the historical parallels? What's going on in terms of the structure of the underlying debt and what have you? But that's where it all started. So, long answer to a short question, but that's where my interest got going. And then it spiraled, snowballed, and took over my life.
Perfect sort of setting the stage for the conversation. In your talking about the situation, you do talk about how when you look at other bubbles, sure, right? Like this kind of feels like this is almost all of them in one. Can you break some of that down?
Yeah, we've hit a quadfecta, if that's a word. The sort of the story I tell is that historically, in terms of Western economies, the largest bubbles, let's just use that word and not define it for a second, generally speaking, are tied to one of 4 things. It could be real estate, it could be loose credit, it could be technology, it could be government policy. So go back over the last 150 years, back to canals, railroads, rural electrification, the sort of the PC bubble, the fiber optic, .com, even the global financial crisis. You can kind of wrap each of these having one of those or more of those as a major factor. So let's just pick on the global financial crisis. What were the major constituents there? It wasn't really a technology story. I mean, loosely it was financial technology, which is kind of a dangerous sort of technology, but it was more about loose credit, real estate, and to a limited extent, government policy, given that some of this was driven by the government's impulse to try and maintain housing affordability by suppressing rates, using Fannie and Freddie as an instrument for kind of hoovering up all of this risky debt. So, but if you go back to rural electrification, or you go back to in the 1920s, or go back to the railroads, each of these has one of these components. And so what's different about this particular historical moment is it sits at the intersection of all 4 of those. Right? We've got a fantastic technology story, arguably the most consequential technology of the last 100 years, certainly as consequential as the internet. In terms of life-saving technologies, it isn't air conditioning, but it's hugely consequential. So, but also there's a credit component, which we've seen spiraling in the last 12 to 18 months. And that's incredibly important because it's really evolved. And a lot of people's thinking about the credit component of this is still trapped in 12 months ago. There's a government component that's increasingly important, because it's increasingly seen as an existential crisis. We're not just trying to produce a technology, we're producing a technology to protect our way of life in an existential battle with China, right? So it's suddenly no price is too high to pay if it's the furtherance of the wealth, prosperity, and growth of your economy, clearly. So that brings in the government component. And then the weirdest one, obviously, is the real estate component. From the standpoint of many of the providers of capital, to the hyperscalers, in particular to these things we call data centers, they are just giant apartment buildings. They are apartment buildings that don't have humans in them, they have GPUs in them. Okay. And so, from the standpoint of the providers of these things, they look at them and evaluate them the way they would any CRE, any commercial real estate deal, any project finance deal, any CMBS. And they look at them from the standpoint of what yield can I generate and over what period, and does that hurdle right? Does that hurdle match the kind of hurdle that I need for my investments as a large institutional investor? And if it does, great. And I joke all the time that they don't really care. Many of the largest providers of capital don't really care what goes on inside of data centers. It could be hide and go seek competitions, as long as the yield meets the hurdle that makes their project financing competitive, given the portfolio of other things they could be looking at. And so that's the weird component. But anyways, to your point, those being at the intersection of government, real estate, technology, and credit makes this a unique moment in Western economic history, because each of those four groups kind of think of it, this is pretty rational. The tech people think this makes sense. It's a consequential technology. The real estate people look at it and say, I got this. These are just apartment buildings. I can totally do this, right? And so on. So you go down the path and you have four independent actors all looking at this and thinking, I don't know what people are talking about, like this Kidrowski guy. This stuff seems totally rational to me. And that's what's really interesting here.
So this sounds pretty clear and obvious when you say it out loud. And it makes me wonder, maybe it's conspiratorial, but do you think there's coordination going on and this is a deliberate expansion of this bubble, or is this just a series of unfortunate events or fortunate events, depending on your perspective?
Well, coordination is really strong. You start to get into sort of conspiracy theorizing. And so it's like, I never ascribe to complex sort of rationales, which you can just ascribe to greed and stupidity. So I'm more of a greed and stupidity guy, that as long as something keeps working, and this goes back to the financial crisis and Prince's famous line that, as long as the music keeps playing, I keep dancing. People keep dancing because the music keeps playing. There is no incentive. There hasn't been. People on the other side of this trade have been punished repeatedly. And so as long as that continues, especially as a pod shop, a large hedge fund, it's very difficult to convince your investors that you just need to be patient with me, because I've got a model here in terms of thinking about how and when the fever breaks and the following trades start working, because in the interim you start having asset flow out the door. And so there's no incentive. There hasn't been a strong incentive yet. It's changing this year, but it hasn't been a strong incentive yet to take the other side. And so there's no coordination beyond the tacit coordination that Michael Burry and others have pointed out, which is that there's an incredibly incestuous and circular kind of revenue flow that underlies a lot of this. And that's very important, because it's not just the revenues anymore, because increasingly the spending for data centers and the associated spending for the projects that sit on top of them is not just funded from cash flows anymore. I mean, because this was the story, right? The story, whenever I first talked about this a year ago, people would say, stop worrying your pretty little head about this, because these are big, profitable companies. They're good for it, right? It is pretty, if they want to divert a material chunk of their cash flows to $100 billion, $200 trillion in data center spending, who are you to say stop doing that? Let's their investors say it, and at the very least, they have the cash flows to support it. If it was out of credit, well, that would be a different story. Well, of course, the story has now changed, right? We're now 12 months later, and as of last quarter, more than 50% of data center spending is coming from what's euphemistically called external financing. Well, what's external financing? That's issuance of new equity, dilutive to your existing investors, giant new equity issuances. We've seen up to $90 billion now. And a huge fraction of it now is obviously external debt, to the point that in both the junk and the investment grade market, a data center and tech related debt is the largest constituent, which is bonkers. I mean, I grew up as a tech equity research analyst in this business, and one of the main attractions of tech was that it had very little debt. Now it's the largest issuer of debt in both investment grade and, well, junk, high yield, which is remarkable. And yet, despite that transition, going from purely cash flow based to going to credit based, where it's increasingly external financing, people are just as confident as ever as what's going on and don't even notice that the alibis, the story they tell, has completely shifted in 12 months. It was okay for this reason, and now it's okay for a completely different reason that happens to be the opposite reason. And that's important because A, it shows you that people are just pursuing a narrative, but it's also important because it shows you that people are missing how the risks begin to grow. Because if it's coming from my cash flow, well, then that's my own decision in terms of how I make payment. But if these data center, the yield on data center of these apartment buildings full of GPUs are being used to pay for my debt obligation, which is 12 years long or longer, and suddenly that's threatened because of changes in terms of the price of tokens, increased efficiency, or something else, then I have a classic duration mismatch problem where suddenly I have a long-term debt being paid out of short-term revenues that are subject to this sort of deflationary impulse of tokens and efficiency gains, and also increased competition from Chinese models and other things. So this is a classic sort of high risk, low reward situation in terms of this transition from the being cash flow funded to being debt funded and the consequences of that. So this is all by way of kind of setting the stage of why, in so many ways, this all gets so mischaracterized and why the risks just keep sort of loading up on top of each other, and yet people still make the same, apologies and excuses, which is very entertaining. It's just somewhat bizarre.
Hey, you made it to the end of the clip. That means you're probably enjoying this. And if so, just know that you can catch us live every Tuesday and Thursday at 12 p.m. Eastern. And if you want to see the full version of this episode, you can click the link in the description down below. Otherwise, YouTube thinks that you will enjoy this next.